Today the topic for the session is going to be indicators. And can someone just tell me give a one-liner answer about indicators? What are indicators and how do we use them? Or just name a few indicators which you might know. Just a one-liner answer. Anyone? Guys, I want the session to be interactive, so don't worry if you're wrong. Just whatever. If you have something in mind, you can go ahead and unmute yourselves and answer.
To pick a way the trend that is going on, we use different methods and tools. So can we say that to be an indicator?
Yeah, indicator is a tool like which will help you in predicting the trend of the market in which way it's going. Yeah, it's right. Can you name any indicators if you know?
Unfortunately, I don't know any name.
Okay, cool. You'll learn in the session. Don't worry.
Okay, thank you.
Is
Yeah,
one of them, is it GDP?
GDP is an indicator, but then it's not an indicator which we use for analyzing charts.
Okay.
Yeah. So I'll name a few indicators. Just tell me with a yes or no if you know them. Like there is a moving average indicator which is commonly used by a lot of traders, and then there is RSI which also stands for Relative Strength Index, and there are Bollinger Bands. Does anyone has heard the names or even once anywhere?
Yeah, I've heard about RSI.
Okay, okay, okay. So now indicators are basically of two types. So the first type is leading indicator, and the second type is lagging indicator. Now, first of all, how indicators are based upon. See, the main thing in markets is the price, and these indicators are based upon price. So we basically use the value of price to calculate indicate to make the indicators. Like different indicators will be using different formulas for the calculation and will have different purpose in the markets. Like some indicators will be used for determining the volatility in the markets, whether the moves are getting too volatile, and some indicators can be used to predict the momentum, like whether there is going to be a trend in the future in the market. In and some indicators are also used for trend following, like if the trend is going and there are minor pullbacks when the price is correcting a little bit. The market cannot just go straight up or straight down. It will make a wave structure, something like this. It will make a wave structure like this. Now, if you see, this is an uptrend over here because the price is moving up, but at some point of time it is also correcting. So these small corrections are called pullbacks, and you can use an indicator which can help you like in telling whether this is a pullback or this is a beginning of a new trend. So a simple indicator like a moving average, which we would be talking in the next slide. You will see like how you can use moving averages to your advantage to determine to get you a better entry, whether to buy or sell. So yeah. So the leading indicators are those which will like give you a signal even before the trend has started, and the lagging indicators are those which will give a signal after the trend has started. Basically, they will be using price and price action to determine, and they will give a signal later. So now there are both advantages and disadvantages of both leading and lagging indicators. Now lagging indicators, as you know, they are lagging, right? So you might have missed a part of the move before your indicator gives you a signal whether to buy or sell. Whereas in the case of leading indicator, the indicator would already give you the information regarding what is about to happen, so you can decide on that. And also, the leading indicators will try to predict price using a shorter time period. Therefore, they will be leading the price momentum, whereas the lagging indicators are going to give you a signal after the trend has reversed or a new trend is taking place. So, the first indicator which we are going to talk about is going to be moving averages. And moving averages, as you see on the screen, it is represented by this line, and how it is calculated, it is basically calculated by taking the average price of the previous few days. Like over here, if you see, it is written 200-day moving average or 50-day moving average or 100-day moving average. So what 200-day moving averages mean is basically like the past price of previous 200 days has been taken into an account, and a mean has been calculated, and based on that this line is drawn. If you see the 200-day moving average is denoted in a green line over here. So this green line is basically like over this point, at this point. At this point, at this point, basically the past price of 200 days would have been taken into account, and this and the value would have come to this. So this is how the moving average is plotted. And you don't need to know a lot about the formulas of the moving averages and all the indicators because they are available. You just need to type the name of the indicator and you can access it. But I'm telling you in a short way like how they are calculated. So basically 50-day moving average would be taking the mean price of past 50 days, and then this point would be plotted in this 50-day moving average, which is represented by the black line over here. Similarly for the 100-day. Now the more number of days you take in account to calculate the moving average, it would tell you about the more longer term trend. Like if you are taking 200-day moving average, it would tell you about the longer trend, like what the longer trend is in the market. So for one basic thing you can do to get to know like whether the price is an uptrend or downtrend, you can simply see like over here the 200-day moving average is represented by a green line. So if the price is below the 200-day moving average, it means that it is going in a downtrend and it's a long-term downtrend. Whereas if you see over here, the 100-day moving average, like and a 50-day, like a 50-day moving average would tell you about a medium-term trend. What's the medium-term trend? Like there could be things in the market, something like the long-term trend is a downtrend, but there is a correction going up. So the shorter day moving average could tell you that the price is in a correction and it would be above the 50-day moving average but below the 200-day moving average. You, as I told, just a second, I think my marker got closed. Yeah. So as I said, like market moves, the price moves in a wave type structure, making higher highs and lower lows or lower highs and lower lows. So let's say if the price is moving like this. So as you see, if the price is going down, it's a long-term downtrend. So the 200 moving average would be representing something like this. But when the price is going up in a correction phase, so the 50-day moving average could be something like this. The price could be above the 50-day moving average, but below the 200-day moving average. So while what this is telling us that the long-term trend is in a downtrend, but when the price is going up for a small correction, you could basically trade a pullback over here, like a small pullback. As you can see in this figure also, like the green line is telling you about the 200-day moving average. So whenever the price is going above it, you can go long, and whenever it is coming down, you can go short. And so moving average is basically used to tell us whether the price is whether the what is the trend in the market. And what the thing happens with people is that most of the people know the indicators but they don't know where to use it. So generally moving averages is used to know what is the trend in the market, and and it is used in trend following. For example, if there is a trend in place in the market, let's say a downtrend is going on in the market, and you want and but it is not clear to you. For example, it could be something like this: the market was coming down, then it went in a range, it like traded like in the same range, and you are confused now, like it's trading in a similar range, a similar price range, so you don't know whether the price will go down or it can even go up after this, or it can go down. So you can use the moving average to your benefit, and if the price is below the moving average, it means that the downtrend is still intact and the price will continue to keep coming down. It can be used as a signal to tell you whether the which trend is in place in the market. Is it the downtrend or is it the uptrend? So that's what you use moving averages for. For example, if you are a long-term trader, it means that you are trading you're trading and taking a position and intending to hold it for a year or so. So you can use the 200-day moving average to know whether it's in a long-term trend or in a long-term uptrend or in a long-term downtrend. But if you are a short-term trader, for say, let's say you want to hold your position just for a month or two, then you can use the 50-day moving average or a 100-day moving average. Now there are all types of moving average. Even there is a 1-day moving average to a 200-day moving average. Now it depends on which moving average is actually which the chart which you are referring to, whichever stocks chart you are referring to, which moving average is the chart respecting. Now, for example, let's say Voltas could be respecting the 50-day moving average. By respecting, what I mean is that whenever the price comes to the moving average, there is a correction or a pullback happening at that point. If you see over here, whenever the price just touched the moving average, it went up again and again over here. So it means it is facing some sort of resistance or some sort of buying is happening over here. That means it is respecting that moving average. So different stocks could be respecting different moving averages. It's not necessary that 50-day moving average all stocks would be respecting. Some stock would be reflecting. Some stock would be respecting a different day moving average. So you have to like put that moving average in that particular stock's chart and then see if the price is reacting from that level. If it is reacting continuously 2-3 times, then you can say that this moving average is holding for this chart. So that was a basic introduction about moving averages and what it is used for. So does anyone has a doubt in moving averages? And also moving averages is a lagging indicator because it uses price to calculate this, so it's lagging. So it will give you a later signal at a later stage. So does anyone has any doubt in moving averages?
I wanted to ask, will a long-term moving average will that be more accurate or a short-term one? Like
Like
suppose if you
accurate in
compare,
what sense?
which would give a more accurate representation?
See, obviously, if the long-term moving average is saying that the price is in a downtrend, but the short-term moving average is saying but let's take an example. Okay, so let's say this is the 200-day moving average, and this is your 50-day. Let's say the price is like this. Price is going like this, and your let's say your 50-day moving average could be something like this. So if you wait a second, it's not clear. I'll use a yeah. Yeah. This example, if you see, like this flat line over here, which I've drawn, is representing the 50-day moving average, and this line, this steep line coming from upside to downside, is the 200-day moving average. So what 200-day moving average is telling us, because the price never went above this 200-day moving average, as you can see, it always remained down. So it is telling that it is in a long-term downtrend. Okay. So if you are a long-term trader, you won't be taking any long position over here because the price has always remained below the moving average. But if you're a short-term trader and let's say you want to hold a position just for a month and you want to trade this small pullback which is happening over here as the price is going and touching the 200-day moving average, and over here as you can see the short-term the 50-day moving average is giving you a signal that the price is crossing this. So if you're a short-term trader, you know that the overall trend is a downtrend, but in the shorter term a small correction towards the upside is happening, and you could take a long trade over here and your target could be somewhere over here over the 200-day moving average because you know the price is respecting this, and over here it would face resistance and then again come down. So you could trade something like this. For example, if you're trading in a long term trend, you won't buy over here, right? Because your intention is to capture a bigger move. So but if you're a short term trader, then you could take a position over here till and your target could be over till here. So obviously, the more number of days the moving average is taking to calculate, it would be giving you a bigger picture of the market, and a shorter term would be telling like a small correction in the other direction is taking place. I hope that clears your doubt.
Yes, yes. Thank you.
So does anyone have any other doubts in moving averages? Anything which is still not clear, I'll go again. Okay, so I hope moving averages is clear. If anyone has any question, they can also like type it in the chats. Okay, so I'll proceed now to the another indicator, which is named Bollinger Bands. Yeah. So Bollinger Bands are a different indicator and it has a different purpose in the market. The purpose of Bollinger Bands is to tell you what is the volatility in the market. For example, if you see in this chart over here, as you can see, the price band is very narrow. Now these are Bollinger Bands. This upper side is you call the upper band, and on the lower side you call it the lower band. And this middle line, as you can see, is a moving average, which we discussed in the previous slide. It's a 20-day moving average as it is represented over here. So now, like taking this 20-day moving average, these bands are calculated. They are calculated by taking a standard deviation from this, so as to get an estimate of the range of the price. Like we can say that if this is the upper band, so and this is the lower band, we can say that based on this moving average, the price will remain in this in between these two bands. So this is one of the way the people use Bollinger Bands. Also, it tells us about the volatility of the market. For example, if you see over here, the difference between the price of the upper band and the lower band is quite low. So what this is basically telling us that the volatility in the market at this point of time is low. Or you could also say that if the price continues to trade in the small range for a longer time, a trend could be seen either in the upside or in the downside. That the Bollinger Band would tell us, but the bands are telling that due to the bands getting narrow, and if the price continues to remain over here for a longer period of time, it could break either side, either top side or downside. And when the bands are quite wide, as you can see over here, the difference between the upper band price and the lower band price is quite high. So that could tell you that the volatility is too much, and you would like try to avoid trading during this time because the market can swing wildly in either direction. It could go down, then again come back quite a margin. So you would try to avoid trading in this time, because if the volatility is too high, there could be a reason that your stop loss could get hit, and then the trade could again continue to move in your favor. So Bollinger Bands has two purposes. It basically tells us it's not always accurate, but it tries to tell us a price range in which the markets will remain. As you can see, most of the candles in this chart are always inside these two bands, either the upper band or the lower band. Very rarely it has gone outside of it, or both in the upside and the downside. So one way to trade using Bollinger Bands is that whenever the price is touching the upper band, you could take a short position hoping for the price to come back to the lower side, because the price is so this could basically treated as a overbought condition, and this could be treated as a oversold condition, the lower band. So whenever the price is reaching the upper band, or you could also say as an overbought condition, it means that the price has simply got too expensive, and people will start selling it so that it again comes to a reasonable price so that they can start buying it. And that reasonable price will be reached when the price reaches this oversold level, which means that the price has simply gone too low and it is very attractive for them to buy now. So one thing which could be done is, like, whenever the price is reaching the upper band, you could take a short position, hoping it to come to the lower band and making a correction. And whenever it touches the lower band, again you could take a long position, hoping it to go to the upper band. Now these upper bands and lower bands will vary again based on the moving average which you are taking. So that depends on how much. That depends on basically for how much long do you want to hold a trade. If you are a short-term trader, let's say if you sell and buy in the same day, you would use a very short day moving average, like 5-day or a 10-day moving average. And if you are a long-term trader, if you want to hold it for a year or more than that, you'll use probably something like the 200-day moving average. And for a medium-term trader who wants to hold like for a month or two, he'll probably use the 50-day moving average or the 100-day moving average. So those two things basically the Bollinger Bands tell us. One is about the volatility. Narrow difference between the upper and lower bands will tell us that the volatility is quite low and it's quite favorable to take a trade at this point of time. And if the difference between the upper band and lower band is quite high, it would mean that the market is too volatile, which means that it could immediately touch the lower band and then immediately swing back again in the opposite direction. It means that there is a lot of volatility, or you could say a lot of confusion, and people are maybe not very clear about where the market is heading next. So you would try to avoid trading during a period of high volatility. And the second thing is the upper band could be seen as a level of overbought, and the lower band could be seen as a level where the price has been sold too much, and it has become very attractive now again for buyers to buy it and pull it to a higher level. So that's how we trade using Bollinger Bands. So does anyone have any doubt in Bollinger Bands? Is it clear, like everything which I said about Bollinger Bands? Also, one thing like what I do, what my preference is, I generally don't use indicators alone to take a trade. I generally use indicators just as a confluence to confirm my analysis. It means that the indicator giving me a signal won't be my primary reason to take a trade. I would rather take it on the basis of price action, something like price action, or maybe a leading indicator which would be giving a signal beforehand the trend is starting. Because what the indicators do, generally you would get a signal very late, like over here if you see, like the band is over here is telling you to over here when the band is telling you to, like over here if you can see, like the band when the over here the price is reaching the lower band, and what I said that whenever the price reaches the lower band you can expect it to again you can expect to create a long position over here and then expect it to go up. But then what happened, the price had already come down by this margin by the time the indicator gave you a signal about buying over here. So that's the con of lagging indicators. They give you a signal late when half of the move is already done. So you might have missed this part of the move by the time your indicator gave you a signal to buy or sell. So just use indicators as a more like a confluence. Like if you already have a view about the markets and the indicator is supporting it, you could use it as a double confluence to take your trade. Also, just don't make indicators the first reason if you are taking a trade. I hope that point is quite important, and I hope that point is clear. Just don't base your trades based on one thing. Use two, three things as a confluence, and then take a trade either in the buy side or the sell side. If the terms are getting too complicated for you guys, then you can just tell me. Like if you are not getting any particular thing, I can just go again and explain that in detail. Can anyone just unmute themselves and say if it's clear or if it's not clear? Because I'm not getting a lot of idea.
Yeah, it's clear.
Okay, fine. So yeah, Bollinger Bands is done and moving averages we talked about till now. So the next thing is RSI, as you said, like some guys just said in the beginning of the session they heard about RSI. So yeah, RSI is a kind of momentum indicator. It is basically used to tell us what is the momentum in the market, and there are multiple ways to trade RSI. There is not just a single way or based on what people use RSI. One of the common ways is that if you see over here in this chart, this is representing the RSI levels. RSI is basically represented between 0 and 100, between a value of 0 and 100, and basically how RSI works is that you could say that when the value of RSI is crossing the value of 60 or 70, it means that you could take that as an overbought condition. So whenever the value of RSI is going above 70, you could say that the price has gone too up, and a correction could be expected at this point. As you can see in this chart, over here right at the top of the trend when the price was continuously moving upside from here to here, the value of RSI touched 81, and at this point it started falling. So that is telling you that the momentum which was in the upside is now starting to wane off, and you could take a short trade over here because the RSI value is already exceeded above 80. As I said, above 70 also you could start selling it because it's an overbought condition, and over here it has gone above 80. So there is a high chance that the price could correct from here a little bit and then again continue. Now, what I mean that the value of RSI reached 70 or 80, I don't mean that a new trend will start from here, that a downtrend. It means that the price has gone up now, but a correction could take place at this point. Like a correction or a pullback could take place, and then the price could again continue upwards. That is the purpose of RSI. It doesn't indicate that a new trend is taking place. It's just indicating that a small correction can be due, and you can take a short trade over here. Although the price is in an uptrend, as you can see from this chart, but then it is telling you a pullback or a correction can be due at this point because the RSI is gone too high, 81. Similarly, for the downside also, if the value of RSI drops too much, let's say below 30, it is an oversold condition and the price could again see an up move from there. As you can see over here, after this green candle close, over here the blue candles are the green candles and the red is the red. So once this blue candle has closed, you can see the value of RSI is just 26.8. So once it crosses 30 or let's say 30, you could take a long trade because the price has come down too much and now it is again attractive for the buyers. So once it has touched 30 or less than 30, you can expect that the price can go up again. So that's how we trade with RSI. Now, some people use the levels of 40 and 60 as oversold and overbought. Like they use 60 for overbought and 40 for oversold. But some people also use 30 for oversold and 70 for overbought. Now, the thing is that there is no hard and fast rule, whatever you can use. So, the thing is, in whichever chart you want to use RSI, just open that chart and select that RSI indicator from the menu and apply it and see whether the price is respecting the 40 and 60 levels more or the 30 and 70 levels more. It can be different for each stock. So just see whichever that chart is respecting, you could take that level for your further trades. So that's one way to trade RSI based on oversold and overbought levels, and it is a momentum indicator, and it is also based on price. So any doubts on RSI? Also, one example over here also you can see the value of RSI has gone very low. I think it would be around 40. So as it touched 40, it again there was a spike and it I think went up to 70. If you see over here, 70 or 65. So that's how you trade with RSI. Once it touches 40 or 30, it means that the price has been sold too much, and now the buyers, it might be an attractive price for the buyers to take it again higher. And whenever the RSI is going above 60 or 70, it means that the price is at quite a valuation, quite a steep valuation, and now it is not very attractive for the buyers to take it even further higher because and the price can't just keep going straight up. There will be some sort of corrections whenever the price is even moving up or even coming down. So that's why it can never continue to move in a straight line. So that's what RSI is telling you, that the price has moved up too much. Over here, if you see, there was no significant correction. It was just moving up. And when the RSI touched 81, you could say that now a correction could take place. So it is basically telling you like when in a trend, when a pullback or a correction can take place. You can see RSI like that. So any doubts in RSI?
So can we say RSI is a leading one, a leading indicator?
RSI is not leading actually. RSI would also be a lagging indicator only because it would give you the signal after the price has dropped. If you see after this red candle has formed, then only it has come down. So it is also a lagging indicator. But then the purpose of this indicator is different. Like like moving average is used for following a trend, while RSI will be used for telling you the momentum of the market. Like if it has gone very high, like towards 80 or towards 70, then you can expect a correction or a fall in the momentum or a correction or a small correction to take place. It's not a leading indicator.
Okay, thank you.
Any other doubts?
Yeah, I just one thing, like when we learned about candlesticks earlier,
Yeah.
like the red candlestick showed the bearish nature,
Yeah.
and
Yeah.
the green one showed the bullish nature, right?
Yeah.
So like, but over here the colors are red and blue. So like, does blue indicate green, or like
Yes. Blue is indicating green only. I think I said that blue is indicating green and red is red. Yeah, I think this the photo which I took over here, it's of I think not of India, maybe of some stock from some another country where they are using blue. But you can say it's green only. The blue is representing the price is going up, and basically the closing price will be higher than the opening price. So it's green only over here.
okay, thank you.
Yeah, and as you can see also over here, two confluences you are getting. One thing when we were discussing about candlesticks, I told you there was an engulfing kind of pattern. When the red candlestick is completely engulfing the green candlestick, which means that the bears are in complete control. And over here, RSI is also indicating you that it is at a very high level or an overbought level. So these two things are both telling you the same thing, that the price can come down now. So that's how you use these things in confluence. Over here also, if you see engulfing candlestick pattern is formed, the green candlestick or the blue candlestick over here is quite big than the red candlestick, and this could also indicate that the bulls are taking control over here, and also the RSI value is too low and it is starting to rise up. So you could say that both things are saying the same thing only. So whenever you are taking a trade, you try to get more and more things in your confluence just to strengthen your view. So that's how you trade. You just don't trade using one thing. Like you just don't take a trade based on RSI. You will also see the candlesticks, and we will also discuss about price action later. So we will combine all those things, and then we can get an even better analysis and a better probability of the trade taking place in our direction. So I think you got a picture how do we combine candlesticks and indicators and then make a view and take a trade based on that.
Yes, yes. Thank you.
Any other doubt in RSI, or should I continue to the next thing? Okay, so I think it's clear to everyone. Okay, so the next thing is Fibonacci retracement. Now, everyone might have heard about the Fibonacci numbers. Like the sum of the previous two numbers will give you the next number in the Fibonacci series. So Fibonacci retracement is also based upon these numbers. So now there is not a now there's not a lot of logic based on this Fibonacci retracement, but it does seem to work. Like these numbers, as you can see, not just in stock markets, these numbers you will see them occurring at various places, and still they seem to work. Now there's not a logic based, like they are not based on some particular logic, but this series has some sort of significance in the market, and it does seem to work. So what this series basically tells us, so based on these numbers, particular levels like 23.6, 32.38.2% and 61.8%, particular numbers like this are calculated, and then they are plotted in the charts, and they are basically used to tell us where the support and resistance are more likely to occur. And they are based on these Fibonacci numbers, which you can see are over here 1, 1, 2, 3, 5. As I said, based on the sum of the last two numbers. So how do we use Fibonacci retracement? So one way which I use it is that when the market is in a long-term trend and you are expecting that a certain correction can take place, like it has been going up straight, as you can see in the even in the case of Adani stocks right now, they were going up continuously straight steeply, or even in our normal charts of Nifty and Bank Nifty, the indices, the price was going up for about 10 from 2011-12 to 2020 it went up. Then in 2020 the price crashed all of a sudden. Now this could have been predicted using the Fibonacci retracement, that till what level the price could have eventually gone down after the price crash. Like we all knew, like no one could have known that the price would crash from there in 2020 because of COVID and all. But then using Fibonacci retracement, you could predict a support or resistance level till what level a correction could have taken place. So what happens in the market is basically if the price is moving up for a quite long time without any major corrections, it would go up and then it would retrace about 50% to its value, and then again it would continue in that direction if it's an uptrend. Same for the downtrend also. If it's in a downtrend, you could see a correction upside to almost 50% and then it would continue. So that's based on what I saw in the charts. So that's what happens. In the next chart, I'll show you how do I plot these Fibonacci retracement levels and how you could use them to calculate till what level a correction could take place. So just a second. Yeah, as you can see, this is the chart of Nifty 50 index, and it's a weekly chart as you can see over here. So, and over here the price which is represented, it is represented from 2004 to 2020. And these levels which you see, which are red, green and blue in color, this whole thing is basically the Fibonacci retracement levels. They are the different levels. Like, is the chart visible, or do you want me to zoom in first a little bit?
Zoom in.
Okay, okay. Is it visible now?
Yeah, we can see.
Okay. So this whole big thing over here, you can see 1, 0.786, 0.618, 0.5, 0.382. These are all are the different Fibonacci retracement levels, and they will tell you like till what level a price could correct when the price has been in an uptrend and no significant correction has taken place. So if you see over here, like this is the 2008 crash. As some of you might know that in 2008 the markets crashed. After that, the market was continuously moving up from 2010. You can see over here 2010, or you can even say 2009, and it was continuously moving up without any significant major correction. By significant major correction, I mean 50%. If you see over here also, from 2004, with this rally was going on, and in 2018 corrected, and it almost came down to half of the price, half of this, like from where it began and to where it went. This whole price range ka half. So it, by significant correction, I mean that that it corrects by at least 50%. So from 2009, the price had gone up. There were corrections. I'm not saying there were not corrections, but not very major corrections, and it was always going up. So when the market crashed over here, you can see over this level, like by 50, generally when the market is going up straight without any major corrections, there will be a crash expected after a few time, and when the price crashes, it will correct by minimum of 50% or even 60% it can go. So these levels, when the crash started, these levels I plotted in the Fibonacci retracement, and I expected that Nifty could come down to this level, 7,000 levels. And as you can see, it almost touched that level, about 50% of the correction, and then again it started going up. As I also said earlier, like the price will move like this, and if it's uptrend, then 50% comes down, and then again it continues the move. And now, as you can see, Nifty is around at 16,000 something again. So when it crashed, it was at 14,000, and if you even calculate a 50% of it mentally, it would come down to almost 7,000. And you can see that the price corrected 50%, almost 50%. I think the lowest low it made was around 7,200 or 7,300. So some people were also expecting that the price would correct by 0.61 or this Fibonacci level, which is around 6,000, but then the price never came down to that. It corrected by 50%. Also, if you see in this 2008 crash, the price corrected almost 50% if you compare by this starting point to this point. 50% of this entire price range. And if you would have plotted the Fibonacci levels here also, you could have seen that it might be 50% or even 60%, because I think the correction is almost 60%, more than 50%. So this is how we use Fibonacci levels. Like if a price is in an uptrend or a downtrend for a long time and there has been no significant corrections, then the price it is expected that it would crash at some point of time and a major correction would be expected. Now crash is nothing but a major correction which is taking place. Now all these points are also corrections which are happening in the market, but these are not major. I think maybe 10% or 15%. So, but when the correction is more than 30 or 40%, we term that correction as a crash in the markets. So, crash is just a big correction in the markets, and that's how we use Fibonacci levels to get an estimate till what level the price can correct. If it's in a long trend and there hasn't been any significant corrections. So, any doubts in this Fibonacci retracement? Now, this would be a leading indicator. It's not lagging because it's taking these levels and it's not based on the price which is continuing forward. It's based on the levels which have happened, and then you will plot it by this. Also, if you want me, then I can show you how to actually plot it in a chart. I'll actually show how do we plot all these indicators in a stock chart. So first of all, any doubts in understanding Fibonacci retracement and how does it work? If it's not clear, I'll explain it again. It's clear to everyone? I see only 2 or 3 people are answering. Okay, I'm assuming it's clear to all of you. Okay. So now one thing, if you want, I can do that. I'll open tradingview.com website, and there I would take a chart, and there I would like draw all these indicators and show you how can we add these indicators in a chart. So if you want me to do that, just type a yes in the charts and I'll demonstrate it to you. Okay, good, fine. So I'll close this presentation for now. Like I just kept these 4 indicators because it's a lot technical terms involved today. So I didn't want it to get too technical for you guys because I know some of you are might even hearing the these terms for the first time. So I don't want to overload with a lot of knowledge in this one session. So we'll go slow. And now I'll open the website, open the tradingview.com website, and then I'll show you. Okay, so I'll remove everything first, then I'll draw it again. Okay, so over here I've opened the same chart which I was showing you in the presentation. It is the
Excuse me.
yeah.
Can you please change the theme from dark to a light one? I
Okay,
guess it will be
okay,
better
that's
looking.
fine. One second.
Thank you.
From where do we change it? Does anyone know? Does anyone use TradingView?
I guess you changed it
I
from
got
your
it, got
profile.
it. Yeah, I got it. Yeah, I think it's better now. Is it visible now properly?
Yeah, it's
Yeah.
visible.
So over here I've opened the chart of Nifty 50, which is an index, and basically it's constituted of the top 50 charts and top 50 stocks. And this is the weekly chart which I am using here because I want to show you the Fibonacci retracement, how it works first. So if you come over here, if you see, this is the 2008 crash, like the price corrected significantly. And you could say that the price started moving from here. I'll just draw a line and show you. Yeah. So the price started from somewhat here, and then the top of this trend was over here from about 1,000 points to 6,000 points. So it was a rally of almost 5,000 points, and then when the price corrected, it almost dropped to this 2,500. So as you can see, more than 50%, by more than 50%, the price corrected. And if you see from 2003 to 2008, there wasn't any significant correction in the market. There were small corrections, like you could say like 5% or 10% max. But then the major correction was pending in the market. So generally what happens after 5 or 8 years, or you could even say 10 years, a correction will take place in a market, a correction which is quite major, or you could even term it as a crash. So, and you can see it, and during a crash, the price would correct by minimum 50%, or it could even be more than that, 50% or 6, or even till 60%. And then after that, again, it would continue in its upward journey or its downward journey based on whatever the long trend is in that stock. In Nifty 50, it's always going to be in an uptrend. There will be corrections, but the economy of a country will always keep growing. So the index will always keep growing. It will be always in an uptrend. So Nifty 50 can be in a shorter term downtrend, but in the long term of over 50 years or over 100 years, because India is always growing, so it will always be in an uptrend. So now I'll plot the Fibonacci retracement levels and just remove this first. In the presentation example, I had taken the Fibonacci retracement levels based on the 2020 crash. Now I'm using those levels to demonstrate with the 2008 crash in the market. So to add these levels, I just go to this FX. If you are using TradingView, you just go to FX and you'll just type the name of whatever you want to use. So it is Fibonacci retracement. Wait. You could do also from here also. Yeah. So you go to this symbol and then select this Fibonacci retracement, and you start from the point from which the trend has started, which is over here if you see, and you go till wherever what is the top of that trend, which is over here. Now I'll zoom in the chart a little bit and extend this further. Yeah, so you can see these Fibonacci levels. As I said, like generally the market will correct up to 0.5 or till 0.6 or 60% also. And you can see the market has almost come down to that level. Now, if someone doesn't know about Fibonacci retracement, when the market starts correcting, he has no idea where the market will find a bottom, right? But if you use this indicator, you already have a slight idea like till where the market can actually go. You have an idea that the market could actually come down to the 3000 level, and then it could again start correcting, and then it could again start moving upwards. So this is the importance of Fibonacci levels. It basically tells you till where a significant correction can take place if a long term trend is going upwards without any major corrections. So this is how we plot it, and the zero is basically the top of the trend, and one is telling you from where the trend actually started, and based on that range, it is actually calculating 0.236 percentage, 0.382 of that entire range. So this is how we use Fibonacci retracement. So in that presentation, it was showing for that 2020 crash. It almost a 50% correction happened. Even I'll be honest with you guys, I was expecting it could come to 0.618 levels as it has done historically, but then again it started continuing upwards. So that depends. It is always not fixed. Sometimes a 40% correction could also take place, and then it could start going upwards. But generally the range is around 40 to 60%. As you can see also over here, it's around 65%, you could say. So that's how we use Fibonacci retracement level. Is it clear? How did I draw it and add it in the chart? Does anyone has any doubt in this? Okay, cool. So we'll move to the next thing now. Now I'll open a different chart. Let's say we'll open Reliance. And let's switch to the daily chart now. Okay, so this is the daily chart of Reliance, and it's the recent chart only, like 6th August, I think was the last trading day, and today is Sunday.